I lost everything when I bought my first stock, and it was entirely my own fault. Watching my hard-earned money circle the toilet bowl wasn't really a nice experience, but since 2016 I've traded UK stocks for a living, and it has been a crazy journey of highs and lows with a steep learning curve. So in this video I'm going to reveal my exact method for researching UK stocks to swing trade, so you can either build a side income or even trade full time in the future that you can use regardless of how much time or financial experience you have. And what if you don't have a lot of money to start with? That's not a problem, because it's actually better to start small and grow an account. I've seen people pile into the market with six-figure sums thinking that they're clever, only to end up losing the lot. So starting small, regardless of how much money you have, is always the best way. And the first stock that I bought was an Israeli OTT top box company called T&Cs, which was a complete dog, and I ended up losing the lot. But what I noticed was that in the days before it actually went bust, this stock would easily move 50% up or down in a day. And I thought that if I could somehow learn why that was, then I might even be able to trade for a living. But there was one clear thing that could have prevented me from losing my money. If I'd known about it before, then I might not even have bought the stock. And this is something that costs investors huge amounts of money, because they gamble on buying the stock at the bottom. And what are the chances that after months of falling that you buy the stock and it's going to be the absolute bottom? The answer is it's highly unlikely. And it's more likely that the stock is going to keep falling, no matter how cheap or undervalued the stock might appear to be. So the first thing that you need to do is stage analysis. And what this means is that you open up the chart of a stock and you decide what stage it's in. Is it in stage 1, stage 2, stage 3, or stage 4? And if the stock is in stage 4, then just move on. Don't even bother to look at it any further. Don't be tempted. Don't think that you're the big man or the big girl or the big whoever who's going to print the bottom. Just move on. If it's stage 1, then you want to add it to your watch list so you can track it. If it's stage 2, you want to put this one on your priority list because you might be able to trade it. You want to look at any potential breakout points. Where's there been significant repeated resistance? And ideally, we want shallow pullbacks as a sign of strength in the market. If it's stage 3, which is categorized by big volume down days, then you want to look to go short, or you want to avoid this, because what this means is that institutions and larger sellers are taking advantage of liquidity. And it's why I said on the Investors Chronicle podcast back in 2019 that I'd avoid Burford Capital and look to go short days before it collapsed 80%. So checking the chart is a great start, but once I bought a stock that was in a stage 2 uptrend and had what I thought had good results, and then it sold off as a result of it. And this is because all I thought I needed to do was check the chart, and I was wrong. What I realized was that actually I had no idea what the company did or even know anything about it, and I was thinking that the results were good without actually knowing whether they were good or not. So if you think about it like this, if a company doubles its profits, it sounds good, right? But what if the company was forecast to quadruple its profits? Then it's actually quite bad, because the company made money, but nowhere near as much as the market was expecting. So in that instance, even though it seems like good news, the stock is probably going to sell off because there's a profit warning. So at the very least, I use SharePad's single page, which I helped design, by pressing enter on any stock. And then this summary comes up, which tells us top level information like what the company does, which in the case of Games Workshop, it builds stuff for kids and men who are going through a midlife crisis, designs, manufactures and sells fantasy miniatures and game related products. So if you've ever seen Warhammer, that's Games Workshop. I then use the forecasts, which you can get to by going to financials, then forecasts. And if you set up my RNS layout, then you can compare the forecasts to what's in the latest RNS before they get updated. So this is how you would see if the results are actually good or bad. And then what I like to do is I like to go on Stockopedia's small cap value report to do some red flag checkup, because usually if there's something negative or deeper in the accounts, then Paul, Graham or Roland will spot it. Now obviously I'm not suggesting that you should follow them or anyone, including myself, because like me, they get plenty wrong too as well, but having the small cap value report as an extra layer of red flag checkup isn't a bad idea. As well as these, I also use Research Tree, and this is a premium subscription that gives me access to various research providers all in one place. So what I like to do is flick through the initiation note to get up to speed on the company, and then the latest brief just to check the forecasts and any commentary. Obviously, all of the research on this platform is paid for by the company, and nobody is ever going to bite the hand that feeds. So you do need to remember that this is marketing material and not independent research, but that doesn't mean that we can't use it to our advantage as long as you're aware of the bias. But so far, all we've done is rely on a chart and other people, and whenever I've done that in the past, I've ended up losing money. When I was a new trader, I'd read bulletin boards thinking that everyone was an expert and sometimes buy stocks because of what someone said on Twitter, which obviously is completely dumb, and I deserve to lose my money that way. And it's quite funny because you wouldn't buy a house without doing a survey and checking for damp or rotten beams. So buying a stock without actually knowing what the business is exactly like that. And so we do need to check the balance sheet and the financials to make sure everything's in order. And what I'm looking for here is a reasonable cash amount, good assets, or if the balance sheet is stuffed with intangibles, then is that reasonable? And I once saw a mining company that had nearly $30 million of intangible assets that were exploration costs. Now personally, I'd say digging a load of holes and finding nothing to show for it is a waste of money, but apparently management thought it was an asset. So looking at balance sheets, we do want to see if they're drawn up by SPIVs or if they're actually fair and reasonable. I also want to see revenue, or the top line, growing on the income statement, because if not, then it's quite hard to grow profits, because you can only cut costs to a certain extent, but with growth, there isn't any limit. But a lot of people make the mistake that profits are everything, and they're wrong, because what actually matters is cash. It's no good making a lot of profit or having high revenues if a business isn't actually collecting its cash, which is exactly what happened with Emporium when I warned people to be careful. Got attacked by various people on Twitter, threatened with a lawsuit, and then within 6 months it had gone bust, and then everyone apologised to me. Nah, just kidding, nobody did. But basically, cash is the lifeblood of a business, because without it, people don't get paid and the business fails. So what we do here is we take the cash balance from the balance sheet, and then we look to see the cash flow statement, divide the operating cash flow by the number of months in the results, and then we work the cash balance back to make a guess of the company's current cash position. Obviously, if the company is cash flow positive, this isn't as much of an issue, but if it is negative, we want to know roughly when it's going to run out of money, because then we can short the stock. Now, if a company is burning cash, but it has 12 months of it at least, and we're only going to be in the stock for a few weeks, it's not really an issue. But if there are a few months left, then you know discounted placing is surely on the way, and so it becomes an instant avoid. So far we've looked at what the company does, we've checked its forecasts, the top line, its balance sheet, cash burn, but here's what really matters at the end of it. What's going to drive the price higher? Because ultimately we make our money when the price goes up, and a dead stock can be the most undervalued stock in the world, but if in 6 months' time it's the exact same price, we've not actually made any money. So what are we looking for here? Well, ideally we want earnings growth, but we also want to check if we're paying fairly for those earnings. To start, we can look at a company's price to earnings ratio, or the PE ratio, and you can either calculate that yourself by taking the share price and dividing by the earnings per share, or you can just let SharePad do it all for you. And a lot of people will say that the lower the PE, the better. That's a lie, just ignore them. And look, paying a low price for earnings can be good, but the best companies will consistently trade on high PE multiples because they're growing very quickly and they're quality companies, so people want to pay a lot for them. And obviously, if there is bad news, those share prices will fall hard because of the high valuation, but all companies fall on bad news. So to get a sense of whether a PE is fair or not, we need to look at the PEG ratio, which is the price to earnings to growth ratio. And we take a company's PE and divide it by the company's growth rate in EPS. So if a company is priced on a PE of 20 and has a growth rate of 20% per year, we'd say the company is priced fairly because this will give a PEG ratio of 1. If the number's above 1, then it can be argued we're overpaying for the company's earnings. And if it's below 1, then it means we could be getting a good deal. Ideally, by buying a company that has growing earnings and a low PEG, we're looking to get a booster as the market re-rates the stock as the business grows. Does it always happen? Absolutely not, but that's the idea. And before the next point, let me tell you a story about a company called Aryan Silver Corporation. Now, the director Jim Williams got paid an absolute whack, so you'd assume that the company was successful, and it completely was for him, but not for shareholders, as you can see. And the good news, again, for Jim, is that he's now retired, and despite only ever failing as a chief executive at Aryan Silver Corporation, he did well enough to buy an Aston Martin, as you can see on his LinkedIn, or maybe he turned into a car, who knows. And I know it sounds harsh here, but the shareholders at Aryan Silver got exactly what they deserved. They bought into an unprofitable mining company that didn't even have revenues because the money that it raised went into drilling for silver. And a quick look at the director holdings would have shown you that Jim Williams didn't have a huge amount of stock and that the company was just a lifestyle vehicle for him. So you might come to the conclusion that the more director holdings there are, the better. Well, unfortunately, it doesn't quite work like that. There was once a company called London Capital Group, and this company had raised money from the stock market in 2016, and in December 2017, when it looked like the company was about to turn profitable, the 90% shareholder decided it wanted to do an MBO, or a management buyout, and take the company private to avoid the listing fees. The share price fell 50% on that news. Or what about Live Company Group? David Siklatira gets a huge salary, yet the share price never seems to go anywhere, as you can see by this share price chart. Now, at one point he did have a big shareholding and was able to use the company for himself and not the minority shareholders, so there absolutely is a thing as too much director holdings. Ideally, I like owner-operators, entrepreneurs who are founders or who've been with the business for a long time and have put some money at risk as well. A management team that have no shares is more likely going to be focused on empire building and increasing their salary rather than the share price. And as the late Charlie Munger once said, show me the incentive and I'll show you the result. Moving on, I then want to know if I'm going to have to deal with market makers or if I can place an order directly onto the order book with direct market access and become a market maker myself. And the way to do this is check if the stock trades on the SETS order book or the market maker driven SetsQX trading platform. I'll then decide how I'm going to enter by looking at where the breakout point is and where can I put my stop loss as close to the entry as possible without being too tight and not giving the trade enough room to breathe. And before I do that, I do want to go onto the bulletin boards because I once found out about a takeover bid that hadn't been disclosed to the market in this way, and it was by reading the bulletin boards. I then called the PR agency and had it confirmed. So before I place the trade, I want to quickly check the bulletin boards on ADVFN and London South East, who've blocked me for some reason, probably because I've said that most people on bulletin boards are morons or because the level 2 sucks. But even though most people are either ramping or paid to ramp or bitter because they've lost money, you do occasionally find some sensible people on there. But still, remember that the majority of posts are trash and should just be ignored. And I mentioned earlier that we can avoid stocks if they're about to run out of money based on the cash flow statement or short them. And there is a way we can actually profit from these situations by betting on the stock going down. So check out this next video where I'll show you what shorting is and how you can use it to profit from bad companies so you can make more money on stocks going down as well as up. Thanks for watching, see you soon.